This is Janus Dispatch, Architecture over Narrative, a field report from the Spectra Flare Yield Market. Spectra on flare. No curve yet, by design. $170,500 a year holds $10.6 million of curve. Morning after morning, for weeks now, I have photographed a Spectra flare yield curve that stubbornly refuses to exist. I am also a liquidity provider in the very pools I am about to call dead. Here is what the dashboard will not tell you, and why nobody running it has a reason to fix it. Spectra Finance is a real growing protocol. $98 million in DEX volume in Q1 2026, 2.4 times over Q4 2025, fresh deployments on Katana and Avalanche, an order book in audit prep. Nobody should call it a ghost town. And yet the flare yield curve on Spectra is dead. Both things are true at once. This is the part the quarterly report glosses over. I have weeks of my own on-chain data to show it, not vibes. What I actually did. Every morning for weeks now, I capture the full flare pool set on Spectra across the fixed rate and yield leverage tabs, logging APY and TVL for every sFLR and stXRP maturity. The slice I will narrate below covers May 17th through May 28th as a representative sample. The routine itself has been continuous because I hold positions across these pools myself. More on that below. The point of the exercise: find a pool I could actually buy into for a clean fixed yield more than 12 months out. Weeks of looking. Here is what the curve does instead. 3 reasons the curve is dead. 1. Rewards concentrate on a single pool per asset. Flare Portal RFLR emissions flow to exactly one pool per asset. For sFLR, it is the September 30th, 2026 maturity. For stXRP, it is June 4th, 2026. Every other maturity gets 0 RFLR. You can read the effect straight off a pool tooltip. As of May 28th, 2026, the September 30th, 2026 sFLR pool shows 14.78% total LP APY, 5.01% from RFLR, 8.69% from native sFLR yield, 0.90% principal token fixed rate, 0.16% LP fees. The reward is the magnet. Liquidity gravitates there and nowhere else. 2. There is no Spectra governance for flare. On Ethereum, BNB, Avalanche, Base, Katana, Spectra, gauge voting steers emissions, spread across multiple pools because bribe markets and diversification incentives prevent monoculture. Flare pools are not in the gauge system. RFLR distribution is a central decision between the foundation that funds it and the 2 venues that benefit. No token holder vote, no market self-correction. 3. The RFLR schedule is locked in for a year. The Flare Foundation's RFLR emissions schedule runs through May 22nd, 2027. It is a foundation subsidy decision, not a Spectra governance vote. This isn't a bootstrap phase that grows out of itself. It is the decided arrangement for the next 12 months. The distortion is structural, not temporary. Where I'm standing and why I'm not pretending otherwise. Here is the part most curve critiques leave out. Several of those thin, long-dated pools are held above the visibility threshold by a single liquidity provider. In 4 of 7 stXRP pools, that provider is me. I seeded mini LP positions across nearly every maturity, partly as an experiment to see whether visibility attracts organic liquidity, partly because I genuinely wanted a working curve to exist. After weeks of running the experiment, the read is clear. Visibility alone attracts almost nothing. One external PT buyer for $346 in my June 2026 test pool. Zero external LP ads. A market that consists of a handful of addresses, one of them mine, is not an organic market. I am telling you this because a critique from inside the pool is worth more than one from the sidelines. I am not short Spectra. I hold sFLR and the pool tokens, and I would be delighted to be wrong. The data just does not let me be. The team explains it away. Someone in the Spectra Discord asked why pools expire years out, yet show lower max APY. The team's answer: on Spectra, anyone can create pools, and some community members have created far-dated markets for any number of reasons. That is the whole thing right there. The long-dated maturities are not a designed term structure. They are permissionless byproducts. Somebody made them for some reason. Nobody at Spectra is thinking in yield curves. They think in reward pools and trading volume. Duration is not their concern, which is fine for a yield farming venue and disqualifying for anything that wants to be a bond market. Same pattern, both curves. The one pool rule is not asset specific. On the same day, the live Spectra flare curves show the same picture in two flavors. The stXRP curve concentrates $9.47 million in the June 4th, 2026 maturity. The other four visible pools together hold roughly $93,000. That is 99% of the assets curve in the single rewarded pool. As of May 28th, the tooltip on that pool shows 2.81% total LPAPY, 1.56% PT fixed rate, 1.20% from RFLR, 0.04% LP fees, with the native sTXRP yield not credited at the LP layer, paid instead as a 2x multiplier on firelight points. The sFLR curve repeats it, $1.14 million in the September 30th, 2026 maturity, three other pools at $5,000 to $7,000 each. 98% concentration in the rewarded pool. Different asset, same one pool rule. June 4th is the live test. The stXRP reward pool matures that day. If the dead curve thesis holds, the $9.47 million will not fan out across the term structure. It will follow the RFLR allocation onto whichever pool gets the next emission, leaving the rest of the curve at the same dust levels it sits at now. If liquidity instead spreads, the thesis is wrong. The answer arrives within the week. What the $25 million number hides. Spectra's Q1 report says stXRP pools did $25 million in DEX volume, highly organic, balanced participation from both PT and YT traders. My weeks of tracking say otherwise. The volume concentrates on the one reward pool. June 4th, 2026, around $10 million TVL. The rest of the curve is dust. The single long-dated pool that tried to break out, September 30th, 2027, filled to its mercenary ceiling and stopped, not into organic depth. Over 12 days of tracking that long-dated pool, here is what happens. May 17th opens at 10.26% APY on just under $7,000 of TVL, LPs rushing in for the reward. Within 24 hours, LP pressure crushes the principal token APY, to 7.47%. The rate whipsaws over the next 4 days between 5% and 7.5% as the pool fills. By May 24th, it finally clears $10,000 of TVL at 5.39% APY. By May 26th, the APY collapses below 5%. By May 28th, it sits at $11,758 at 3.71%. Plateau confirmed. That is not a trend. It is a pool finding its mercenary ceiling. LPs deposit hoping to earn fees from active PT and YT trading. The trading does not arrive. The LP fee component sits near zero, around 0.04% on the June 4th pool, and the only meaningful yield is the sFLR subsidy thinned across more capital as new LPs add. The displayed APY whipsaws while the pool fills, then settles where the per LP slice barely justifies the deposit. By May 28th, that level is $11,700 TVL at 3.71% APY, capital mining a subsidy, not earning a market. Balanced participation does not survive contact with the order log. Who actually wants this fixed? This is the part that turns a complaint into a structural observation. The sFLR subsidy has 2 recipients and 1 payer, and their incentives point in opposite directions. Spectra wants TVL. It earns trading fees, and more TVL is a win whether the capital is sticky or mercenary. Spectra wants sFLR demand. Every sFLR that lands in a Spectra pool is FLR staked through Spectra. More AUM, more fees. Neither has any reason to want the subsidy to end. The only party that does is the Flare Foundation, which pays the bill and hopes the ecosystem eventually stands on its own. Watch the tell. On May 25th, Spectra celebrated the new September 30th, 2026 pool, crossing $1.1 million in a week, as our community leveraging the power of liquid staking. From their seat, entirely honest. The minting already happened, the AUM is real, mercenary or sticky is somebody else's problem. But that 1.1 million in a week is not a counter to the dead curve thesis. It is the proof. sFLR rotated onto the new pool the moment the old one matured, and liquidity jumped straight to the single subsidized point, not spread across the curve. That is reward chasing in real time, not organic demand for a yield lock. If holders actually wanted term structure, the deposits would have fanned out across maturities. They piled onto the one with the carrot. So the wean-off question answers itself in the worst way. No one with operational leverage is driving it. The subsidy's beneficiaries have grown fond of it. The payer has to force the transition from the outside. That is politics, not mechanics. The FIP.16 wrinkle, the honest counterweight. In parallel, FIP.16 is reshaping FLR tokenomics, lower inflation, fee burns, MEV capture, and FLR buybacks through a mechanism called FIRE. For Spectra's liquid-staked sFLR, the trade is yield quantity down, yield quality up. For an FLR holder, the deflationary path reads as a positive. The harder question, whether the activity those buybacks feed on is organic or rented, I dissect in a companion piece, Rented Deflation. Here it is enough to say where it leaves me as an LP. I keep the bulk of my stack in native staking, not in Spectra's reward theater. Native gives me the yield and the full price upside. The Spectra pools are a side experiment, sized to lose without it mattering. What Spectra is building and what it doesn't fix. Credit where due. On May 26th, Spectra unveiled Metavolt of 2, and Gaspar laid out the roadmap: cross-chain routing, RWA, and carry strategies, NAV reporting, and, most relevant here, liquidity rollovers and a native order book, both built ahead of launch. The team calls rollovers the biggest pain point of fixed-term markets, reports zero-friction execution at small scale, and a significant pool expiry next month as the first test at scale. Those two features target exactly the mechanical pain points I just laid out. Rollovers eliminate the lock-until-maturity trap. The order book kills the 37% slippage on a $59 trade in an $8,000 pool. I will be the first to cheer if they ship cleanly. But here is the line that matters. They fix the mechanics, not the economics. A rollover simply moves liquidity frictionlessly into the next sFLR reward pool. The order book makes reward chasing frictionless, not broader. Mercenary capital no longer flees abruptly. It rolls elegantly to the next carrot. The sFLR concentration, the actual cause of the one-pool curve, is not a mechanics problem Spectra can engineer away. It is Flare Foundation's subsidy policy. Spectra can build the best vault framework on the market. V2 may well be exactly that. And the curve stays flat as long as one pool per asset gets bombed with 60% ARFLR. The problem sits one floor up with the party that steers the subsidy. That floor is where rented deflation lives. The same subsidy logic, read as FLR tokenomics instead of a single yield curve. The one thing in the roadmap that could touch the economics is the planned Spectra tokenomics upgrade. If it brings Flare into the V-Spectra gauge system, emissions would spread across pools by vote instead of by central decision. That would be the structural fix, the only item on the list that addresses the economics rather than polishing the mechanics. Worth watching the governance forum for it. Even if that upgrade lands and brings Flare into the gauge system, the current sFLR structure is locked for the next 12 months. The published schedule runs through May 22nd, 2027. Bootstrap is the framing the foundation would use. Duration is the framing that matters. Where the curve is forming. In May 2026, the same month the Spectra Flare curve was producing 99% concentration in two assets, Morpho published the Midnight White Paper, a fixed-rate, fixed-maturity lending protocol on EVM. Same mathematical primitive, zero coupon obligations split into credit and debt units, different architecture. Markets are isolated and immutable, created permissionlessly. No central allocator decides which maturity gets the rewards, because there are no rewards. Makers post offers that do not lock capital and source liquidity only at settlement, letting them quote across many markets at once. The fragmentation problem that kills Spectra Flare's long-dated maturities is addressed at the offer layer. One signature across many markets, with capital staying productive elsewhere until filled. The point is not that Midnight will replace Spectra. It is that the architecture for fixed-rate term-structured lending demonstrably works when it is not bent around a subsidy magnet. The curve is being built, just not where the sFLR allocation decides it cannot form. What DeFi Llama hides. There is one more way the flat curve disappears from view. The TVL, the dashboard renders as ecosystem health, is a function of the subsidy, not of demand. The two rewarded pools together pull roughly $170,000 of annual sFLR distribution against $10.6 million of held liquidity. That is a 62 times cash subsidy multiplier. Every dollar of sFLR recruits $62 of mercenary capital. The stXRP pool carries an additional non-cash subsidy, 2 times Firelight points to LPs, that sits outside this calculation and pushes the true recruitment higher, not lower. Strip the sFLR, and the curve collapses to the dust levels every unrewarded maturity already shows. No loan market consumes the duration. The held capital has no consumer except the next payment. What DeFi renders as ecosystem TVL is, on this curve, a balance sheet line for the sFLR program dressed as adoption. And it cannot scale, because the subsidy itself is finite by program design. This sets the open question for the Flare Foundation: how much sFLR is allocated to Spectra Flare pools, and on what schedule does it expire? The multiplier above is computed from the only data the Foundation has made public: the per-pool LP APY shares visible in the Spectra app. The aggregate allocation and the run rate against the remaining program reserve are not. Until they are, the $10.6 million reads as a lever with no published ceiling. What I'm watching for 90 days. The order book. If it ships, it routes around the AMM slippage that makes thin pools untradeable today. An order book would make maturity choice real, even without deep AMM liquidity. It is the only mechanism in sight that could revive the curve. sFLR rotation. When the stXRP reward pool matures on June 4th, where does the reward go next? And is the successor a long-dated maturity or another short one? The next scepter, yield print. Does the FIP 0.16 drop show up, or does the P-chain boost hold the line above 10%? Foundation transparency. Whether the sFLR aggregate and remaining run rate for Spectra Flare get published, and how loud the silence is if they do not. The cleaner address. Spectra Flare is a growing protocol with a broken local yield curve. For traders chasing the reward magnet, it works. For liquid staking holders who want to build a maturity ladder, it is unusable until something changes. Most likely, the order book. If you want fixed-term structured sFLR exposure today, you cannot get it here. Native staking through Scepter, or Doppler, gives you 10% running and full price exposure for the FIP 0.16 thesis, with none of the reward theater. That is the cleaner address. I will keep photographing the curve every morning. The day it stops being a single reward pool and a handful of addresses, one of them mine, propping up the long end, you will read it here first. That was Janus Dispatch. Sources, charts, and the full data table, May 17th through May 28th, are in the published post. Next in this cluster, rented deflation. The diagnosis at the tokenomics layer, where the same subsidy logic shows up not as a dead curve, but as a deflation claim that has not yet shown its root. If this dispatch sharpened your read, subscribe so the next one lands in your inbox. Janus Dispatch is at janusthewatcher.substack.com. The long arguments are in the books. The transition sequence, 2 volumes, 1 thesis, the ground is shifting. Book 1, The Proto-Post-National Age. Book 2, The Allowance Economy. Architecture over Narrative.